Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 13th, 2020. In this video, we're going to take a look and do an update on all the active trade ideas on the site. Currently, we have 10 official active trades, and if you're new to the site, what an official trade is, those are trades that are laid out with specific entry points, specific price targets that I've adjusted. I've looked at where these trades are likely to have a reaction at each point, a significant reaction, meaning a consolidation and/or a bounce off the initial tag of that level. You can find in the FAQ page under resources at the top menu, and then going down into FAQ, frequently asked questions. It'll list why I list multiple targets. Again, that's up to each trader. Some people might want to book quick profits, or might only want to target a shallow, pullback on a stock or a relatively small bounce, where other traders are more trend traders and they want to capture a bigger move or the bulk of the trend. And yet you have a combination thereof, like myself, an active trader, that might game the reversals off each of those tags. In other words, you go long on something, first target's hit, you can reverse, sell your long, short a quick pullback trade, cover that short on the pullback, and then get long again for the ride up to the next target if the charts are confirming at that time. So again, I can tell you that those, in advance, those are the levels that I suspect we get reactions. I'd say easily, if not more than 90% of those trades, all the trade ideas on the site do have significant reactions at those levels. And again, I define a reaction as either a pause or a consolidation when a price level's hit, or a reversal and an outright bounce, and maybe sometimes it's a lasting reversal off that level. So by a reversal, I mean if you're on a short trade and you hit a support, a reaction would be a bounce or a consolidation there before the next leg down. All right, let's start out here. There's 10 active trades on the site, and again, active trades, or official trades, I'm sorry, are those that list the exact trade parameters, suggested stops, suggested targets, and they're just that, suggestions based on my analysis of the chart, based on the entry around that point in time. In other words, if you get a trade idea, let's say you didn't take one, you waited a little bit, and you got a better entry, or you got a less favorable entry price, well, then you probably want to use a different stop that's more in line with where you entered and where you're targeting. All right, so I want to start out with the S&P 500 because this will determine where the majority, at least half of these trades go. What I mean by that is we are diversified, or at least I am personally, and on the trade ideas on the site. In addition to an index short, which is SPY, the S&P 500, we also have a short on the semiconductors, a short on two components, at least within the S&P 500, three of them actually, Costco, Verizon, and Berkshire, and and a lot of those semis are also in there. So what I was going to get at here is I'm either going to be right on all of those trades or probably wrong on all of them, and hence that's one reason to diversify, spread my bets, have some commodities, have some even bonds. Those are three different asset classes right there: stocks, bonds, and commodities, and we have trades on all of them. So I'm going to go over those today. Let's dive into the charts here, because again, where the market goes will determine, most likely determine the success or not, or the fate of most of these trades. And I'm going to start out here on the monthly chart and just real quickly say, and sometimes I don't have a strong opinion on where the market's going or what I'm seeing in the charts, but I can tell you now definitively, and I'll put the disclaimer, I'm going to be wrong at times. That's the only guarantee I'll ever give you. I can be wrong, but I can tell you right now, by all metrics, the stock market is still in a bear market. There's not anything in the charts. We haven't exceeded any Fibonacci retracements off the high. We haven't regained any important trendline breaks. We're looking here at a monthly chart spanning decades, going back into the we can go back into the 80s if we want here, and we can see the last several bear markets right here, and they all had some similarities. They all had these divergent highs leading up to it. They all had some nice clean up trend lines to define the trend, and then sell signals. Sometimes you back test when you break a trend line and then drop, and sometimes you break the primary bull market uptrend line, and then that's it, and you never look back. We'll never know for sure which one it's going to be. Sometimes the charts might give us a little bit of an indication, but you can see. So these are our last bear markets. This was a super bull up here to the 2000.com bubble top, followed by a 51% drop. There's the top in 2007, followed by the Great Recession, they called it, and a 57% drop in the S&P 500. And again, all the similarities here with these primary trend line breaks. And then this was really my primary trend line right here, that yellow one for the S&P 500, which broke down all the way back in 2018 and back tested it since and finally rolled back down. What happened here is it was back testing even though the S&P 500 broke down, but the techs, QQQ, the tech heavy NASDAQ 100 held above trend and then finally broke down more recently. So that's it. There's your bear markets, and you can see again the similarities with the divergent highs. And then the other thing is, again, this is just a recap for those who've been with right side of the chart for a while, or even following on the YouTube channel. I've shared this long-term indicator, very simple but effective. The 20-month exponential moving average just does a phenomenal job. It's that dashed blue line of defining bull and bear markets. When you cross below it on a monthly closing basis, that's what you need to see. You need to see a solid monthly close that you've then entered a bear market. And like most moving averages, when used as a trend indicator, once you're under it, it often acts as resistance on back tests, and it tells you in a bear market you want to look to short the bounce backs into that 20-month right there after you get across. And there are some what appear to be whipsaw signals, but for the most part, if you really zoom in tight, you'll see a lot of these were stick saves. We either closed just marginally below it. Again, you want to see a solid red close, a big red candle like this, and then a couple monthly candles after that will certainly help. Then, like you had right here back in 2007, early '08, then you back tested. There was your chance to get out on that first bear market rally before the big drop came right there. And again, that's where we're at right now. You can see in recent years we've had some close calls, but they were mostly stick saves where you rallied back up to close the month either just back above or a hair below, but not far enough to say, okay, that's a definitive break. You had one right here, then the following month you close right back above it. And then here we had a big red solid. This is what, again, when I refer to a solid close below, and it's a monthly chart, so you need to see where the monthly candle closes. That's where we closed last month. So we took out the primary trend line, this secondary trend line that I have right here. I call it the benefit of the doubt, BOD trend line, and we're back testing that now. There's your 20-month. We also kissed that, almost kissed that, and we're still below it. So I want to just spend a little more time on this one trade because of the importance. Again, the stock market somehow manages to pull a rabbit out of its hat and head on up and get back to the old highs or even close to it, it's going to regain some of these trend lines, these important trend indicators, and that could change things. But as of now, again, whether we want to look at this monthly chart, whether you want to zoom down to a weekly, daily, like I said, by just about all metrics, this has been nothing so far. Again, just so far. Anything else can happen going forward, but nothing more than a bear market rally based on all trend indicators and the percentage of a retracement so far. Okay, so that's all long-term, big picture stuff, and when I think it's critical as a trader investor to formulate the big picture to then decide to really, and this is a dirty word I think in trading, are biases. Confirmation bias is one of the worst, I think, the worst enemies of a trader or an investor. Confirmation bias is hearing what you want to hear to support your views on a stock or the market, and then disregarding anything else anybody says against that view is either just blowing it off or just almost not even processing it. That's confirmation bias, and I can tell you it can kill you as a trader or an investor. But with that being said, on the flip side, I always hear people say, oh, just trade the charts, do this, and you have to take a side. Otherwise, you then suffer from what I call paralysis by analysis, where you can second guess every little move. So where I'm going with this, if you're in a downtrend, then you have to sometimes give the benefit of the doubt or skew it towards the bearish outlook. In other words, on a rally like now, you want to short into resistance, which we've done. That was the basis for entering this SPY short trade. And in some points, you're going to disregard or put a lower weighting. It's probably more accurate. Put a lower weighting on some developments that kind of go against the larger trend. I'll talk to that in 1 minute when we get to the gold trade. I'll talk about those divergences I pointed out today. All right, so just to kind of zoom into really more near-term stuff, because again, that long-term monthly chart I started out with, it's going to do you no good unless you're maybe a 401k trader, an investor, because you're not going to make any changes in your positioning anytime, whatever happens today, tomorrow, maybe even over the next week. But as an active trader, if you're short, a pretty good sized position in the S&P 500 or any of the various tracking ETFs that I talked about, you can use SH to short the S&P 500. You buy that and it'll just be a one-time short. And then there's a lot of other leveraged long and short ETFs. But in more active trading, it does matter where the next 5-10% it goes, where we go from here. That will matter on your position. Whereas on a longer term trader, it might not. So let's just review this trade real quick and then we'll move on. So far, we had this bearish rising wedge pattern. Nice clean too. Here's your divergence line right there up top that finds the top of the wedge, and divergence here on the RSI, which we didn't have until this point here. We had a breakdown, as I mentioned this morning, or in the update earlier today. It was pretty impulsive, nice red candle as we want to see. Fell down to that first support that I had on this chart since last week. That's 273.39. Nice level there, big old gap back here to help, find that. You can see we danced on that level for a while and then gapped down below it right here. That's what defined that level. We rallied up to it, failed right here, and then popped it recently. We're back testing it. So this is a very important level because this was, if you look at it this way, let me change drawing tools down here. Give me 1 second. I'll do a frame tool and change the color so you can see it a little better. Okay, all this right here was a breakout right there because we failed there once. It was an important level. We tried it again, then we gapped above. We're back testing it now. So, TA 101 says, and if you're bullish, you can go long here, you buy support. There's a breakout and a back test of the support level. So the bulls want to see and need to see this now and go up, take away the highs. There's still resistance up here at 288, but I'm keeping the stops relatively tight on this one for now, although we're using the daily close. Whereas bears want to see this. If it can break below that level, and again, this reaction so far today is typical. There's a reaction. That was the first support level below. This is a reaction where we didn't bounce, but we stopped going down once we hit it. And we've traded along that level all day long so far since we popped down there this morning. So, to keep this trade alive and well, we want to see this level go with conviction. What does that mean? A nice red candle, or just really, I think at this point, if you take out today's low of 271.41, that should do the trick, and then it works this way. Here's your next support level, 263.19, but it's an official trade, so I've set the price target just above in case buyers step in early, and so on and so forth. If that level breaks, we'll probably get a reaction there. Whether we do or don't, the next sell signal comes on the solid break below that level and then opens the door down here. So that's it. Nothing much else to say about that. We'll see how today ends. If they happen to rally it up, you can, and again, I always encourage everybody to use stops based on their own risk tolerance, their own stop allowance, and that's even assuming you took the trade to begin with, because it may not mesh with what you think. You may think the market's going higher, don't fight the Fed, or whatever reason, Corona's going to go away soon, or just, hey, buy the stock market, buy dips. I don't know. But if that is your mindset, then like I said, if you are bullish, you could certainly step in here at this or any of these support levels, and use those levels, because there's one thing I do pretty good. It's identifying the levels where there's a good chance you're going to have a reaction. In other words, key support resistance levels, trend lines like that. You get the breaks of a trend line. There's your sell signal, big gap down, and that. So, bullish scenario. Well, we could bounce here. There's still significant resistance at 288. That's certainly a possibility to see, but I don't want to see the SPY get up so far, so I'm going to leave these stops alone for now. If anything changes, I'll let you know. There's our entry price, was at 273.17, so we're virtually flat on that one. Again, we're trading right around here. Quick update on QQQ. We're right now out of this one. It's not an official trade, but I know some are in it from the last one. We had a divergent high recently, and QQQ is just kind of same thing. It's kind of stalled out here, moving sideways. The Fed has come in very hard and heavy. They've come in magnitude of order. uh, more aggressively than they did even back in 2008. So I'm going to talk about that in a second when we get to LQD. But while we're on the broad market, let's just stay here on these broad market related trades. So let's hit those first. Berkshire Hathaway. Again, unlikely that this one's going to hit the final target without the S&P 500 taking another leg down. So Berkshire, we entered that last week at 195.90. It's profitable today. It's down 3.2%, but again, nothing to write home about. If you're considering taking profits here, then you should have had a much tighter stop than the suggested close. This one, remember, I'm looking long term on this one. I'm basing it off the weekly chart. I know sometimes I fail to mention which time frame we're talking about. It's always up here in the upper left hand corner of my charts. This is BRKB, that's Class B shares, weekly chart, and that's what I think happens there. This is a big divergent high right there. I already went over this trade before, the whole basis and the reasoning for it, but I still think that over time we get this. There's certainly more upside potential here before we roll over. There's resistance overhead about 272, the 40-week moving average, so I'm giving this one a little room. I think that's what it's going to take in this market, again, with the heavy Fed intervention going on right now. I do believe, and I'm a firm believer, that they can only postpone the inevitable, that the fundamentals are going to take the market where it needs to go, and all the money printing in the world and intervention into the financial markets again will only prove to be a temporary measure, just like 2008. It's not that the market finally stopped going down because the Fed finally got did something right on March 6, 2009. No, it hit a point where stocks, even pricing in the recession at the time and all these worst case scenarios, stocks were dirt cheap down back then, and so that's it. The market ran its course. So everything the Fed did, in my opinion, was futile. And me personally, I wish they would have let the big banks fail. And I'm a firm believer that little banks and other banks would have sprung up in their place to fill the void, and the world would have kept turning. But no, they didn't do that. So here we are today again in the same mess where they're having to backstop the banks once again because they're too big to fail. But all right, I digress. Next one up, Costco. Costco, we entered that. This is also based on the weekly chart. Entered at 301.55. We're about flat on it, 299. We'll call that flat right now. Not much else to say other than it really needs. I'd really like to see this trend line and that 282 level go. That's the first target level is 282. There's a trend line right there as well. So when that goes, that opens the door up for T2. And again, I can't impress this enough. This is based on the weekly chart. You just have to give these things room. Like any trade, they're either going to work out or not, but don't expect instant gratification on a trade that's based on a weekly time frame. It may take a little time to play out, or if we start to take another big leg down like we did recently, it could play out quick. And somebody asked me that question on the homepage last week, and I said I gave my time frame as to when the targets would be hit. And T1 I gave anywhere from a week, I think, up to 6 weeks. I'm going from memory. It all depends. It all depends how things play out here soon. I just wanted to zoom down to the daily chart here and show you that Costco has this sort of asymmetrical triangle pattern. You have that uptrend line right there off the lows, and I think that's the same one. Yeah, it is. I had before. It comes all the way off that low back here in December 2018. Very big trend line, and that 280 62ish support. Same levels I was showing you there on the weekly chart. So if and when that goes, that's a big level, and then I would expect a pretty swift, just based on my view of the chart here. There's a little stop point or a checkpoint along the way, but I think it'd be something along these lines. A pretty quick move down to that midpoint there, about 265, have a little reaction and come on down here at about 246.44. You can look at the volume of price histogram if you can make it out in the video. These green and red bars shows a lot of the trades occurred up here, and then there's a big thin zone void between here, that 280.62 level and then that 246 level. And thin zones are a lot like a gap. Let me just put that midpoint line in there, right about there. So 260, we're going to round it up 263. Again, if you're an active trader and you're looking to either cover or do anything around there. I think we get a little reaction point, but I think we'll ultimately go down there before we have a decent tradable bounce, most likely off 246.44. And next up, Verizon, another S&P 500 component. And there it is. Looks good. I'm going to zoom in a little bit. I've already went over all the past history similarities between these rising wedge patterns, these trendline breaks like this, peak, at the divergent high, the peak to trough drops there, 25-30%. And again, we're off to the sharpest turn in the economy. Either in history or at least since World War II. I've seen different statistics, but we went from firing on nearly all cylinders to the engine almost stopping cold. We haven't seen anything like this before. Shut down the U.S. economy, and so point being, based on the chart alone, back out what's going on in the economy, literally, and just based on the chart alone, had I seen this, I'd still say this one had a lot more to go. Now, based on what's going on with the economy right now, and the fact at best I see it coming back online slowly, not just a hard restart of the economy. People aren't going to flock into crowded restaurants and football stadiums anytime soon. And crowded airplanes and airports. So like I said, it'll probably be a slow reboot of the economy. Eventually Corona will be behind us, or at least to a good degree, but not for the very foreseeable future. So therefore, the basis for this trade was technically based largely, there it is, we shorted, at the downtrend line, little reaction so far, nothing big. We're only down 1.5%, or up on the trade 1.5% today, but that's it. That's how it looks right there on the daily chart. Same downtrend line, confluence of moving averages. And I did want to point this out on the 60-minute chart. Here's what we have recently. You have a couple things going on here. Most importantly for today, this is why I wanted to update this. Well, leading into lows, like the stock market, everything else, this was a catalyst for the bounce, a technical catalyst. These bullish divergences, overbought conditions, extreme bearish sentiment, or oversold, I should say, all here at the bottom. And again, that was a fuel for that rally in Verizon, which was to the tune of about 18-20%. And now we've come full circle. We have a nice little uptrend line, which the stock just broke down below, and heading up into the recent highs, we had a nice little small divergent high. This divergent high is small. It's a lot smaller than this. The positive divergence was large. But again, if we are in a bear market and it's a bear market rally, it doesn't take much. Small little divergent high can often be the catalyst for the next leg down. But what we need to do is, see this breakdown stick. Maybe we back test. If we do, you could get a reaction off the trend line. There's still plenty of room for another kickback rally and keep the divergences intact. You can see as I draw here, we'd still be making lower highs if it was just a marginal new high like this. And here's your target zone. You have a downtrend line that would come into play right here, right around this 54.21 level. That's just short-term stuff. Again, this trade is based on the long-term weekly chart, and you can see the targets down here on the weekly chart, but I wanted to give you kind of an update near term. So where I think this stock's going to go today and tomorrow, next week, is right here based on the 60-minute chart. Where I think it's going over the next few months is based here off this weekly chart, if that makes sense to you. I always need to be clear on that because I know I confuse the heck out of people sometimes. Randy, I thought you were bullish on XYZ or long or short it, and now you're talking. Again, I can be near-term bullish on something, intermediate-term bearish, and then long-term bullish. So it all depends on the time frame of the chart. Near-term talking hours to days, sometimes weeks, depending on what time frame I'm looking at. Intermediate term, usually talking weeks to maybe a couple months, and then longer term would be months to even years. All right, next up. Okay, completely different asset class, but somewhat related to the stock market. On this trade, I already talked quite a bit on it last week. I decided to pull the stops that day and reinstate them, which I did, and we'll leave it here now. I'm debating on what to do with this trade. I'm going to leave it on for now, but let me just say this. What happened Friday, and again, the logic for me pulling that stop and put it back in, there was pretty much worst case, and I still believe that. For worst case scenario, the upside is limited. So whether I leave this on, pull it, close it, whether that stop is hit. You do what you want with it, but I also think the downside's limited. What happened on Friday is the Fed invoked emergency powers, emergency authorization. I forget there's a number to it, article number, blah, blah, blah. They've only done it twice in history. They did it in 2008, back in the before that it was in the Great Depression, or in 1929 or something. And what they did is they've changed the rules of the game. They've come in and they're going to buy an unlimited amount, whatever it takes, of if what they call fallen angel bonds. These bonds, the whole basis for this trade, fundamentally, that huge tranche of triple B rated bonds are being downgraded. Like Ford was investment grade, they got downgraded to junk. The Fed stepped in and bought Ford's bonds. And beyond that, they've also been authorized to even buy ETFs, particularly this one in particular right here. They said ETFs that hold mostly investment grade bonds. So what they're doing is they everything that I've talked about for weeks, they're quite aware of that. And again, they've changed the rules of the game where they normally could not buy junk bonds, below investment grade rated bonds, ETFs going into the market like that. So it's a game changer. What it's going to do, it's going to put a floor, at least temporarily. I'll say this: I am a firm believer that the fundamentals will overwhelm the Fed, and they cannot stop the inevitable here, especially if the economy doesn't get back online to a greater or lesser or greater extent going forward in the very near future. They can print all the money in the world they want. There's going to be unintended consequences. What I think is going to happen here, you're going to have a lot, and I mean a lot of fund managers, smart money, a pension fund, CalPERS, you name it. All these, this is where the bond market is it's larger than the stock market. And these fund managers right now have a free out. They've received a stay of execution. All those, think of CalPERS, how much money they have in bonds. So that's the world's largest, and largest pension fund in the U.S. I use them a lot for an example, but they're all in the same boat. They all got caught and didn't think that things would unravel that quick, and it did. Now, for those that held on, they have a reprieve, and they were probably led in advance to believe that the Fed would come in and do this. The Fed probably let them know, hey, hold on. Now, what they're probably going to do, I imagine, is going to be a good deal selling. Why not? Look where we are in corporate bonds. Think about it. This was the all-time high in the stock market, or all-time high in LQD, and we're almost there right now. It blows my mind from a valuation perspective, these corporate bonds with what's going on in the economy. We're about to embark into earnings season here. And this is just going to be the start. And by the way, when earnings start rolling out, guys, keep this in mind. Companies report earnings on a quarterly basis. That's a 3-month period. By the time they report their previous quarter, the quarter is already a month over. So what I'm getting at, you're about to hear earnings and with the impact of Corona, most of which is up to 4 months old before this mess even started. Okay, so this earnings season, you're going to start to get, and the companies will, a lot of them have already retracted giving any guidance, and so you're probably going to hear a lot of open-ended stuff like this, but I want to just say the next quarter is going to be worse than this one by far, and the market's probably going to price that in sooner than later here. And all I was going to say is I think you can stay short LQD for a long time. The Fed's not going to buy up those low-grade bonds up to the point above where they were. And again, I think we're going to see selling pressure. I think this was a lot of shorts got caught in that, and I do think we're going to drift back, at least backfill the gap, probably come down and hit this T1. I would put a very high degree of confidence we'll hit this T1 within the next couple months. Could be weeks, but 2-3 months. And at that point, I'm going to leave everything on for now. If it gets stopped out, maybe let it go, because they're not going to let it, at least anytime soon, get down too far. They're probably going to try to prevent this as hard as they can, but at some point I think they're going to get run over. The analogy I'd like to use here, now, I don't know if this was true. There was a myth going around when there was what was it, Irma? One of the big hurricanes coming to the U.S. A while back. And I know there's all kinds of things spun in the media, fake news, but there was something out there that Trump was entertaining the idea of using nuclear bombs to deter the course of the hurricane, to fire up there and try to steer the hurricane away from the U.S. Now, whether that's just, fake news made up online or not, I want to use that analogy here. That's what the Fed is doing right now. And I imagine if you shot enough nukes up, when it was over there halfway across the Atlantic, away from land, I imagine enough nukes might be able to, all you have to do is slightly alter the course of a storm like that, and it's, you could maybe alter the path. But again, it's a ridiculous idea, obviously, for many reasons. But that's what's going on here. So the Feds literally, and if you read about this, they went full-blown nuclear. They used the nuclear option here. This is dwarfing anything they did in 2008. So they threw a lot of money. Again, I think the money's not going to work. It's more so I think a lot of traders got on board, and a lot of shorts get squeezed out, and a lot of believers that the Fed's going to take this market back to new highs, and I think that's going to be faded. I just want to say that that's what's going on here. So enough on that. Again, are they going to let it get down here? I don't know. We'll let the charts be our guide, and what I'll probably do is just play this one by ear. If it gets stopped out again, let it go, because now, knowing that they're going to come in and they're going to buy out this ETF in particular and a lot of others like it, as well as the bonds that are in there to support it and to prevent those triple B bonds from going down. I still don't see how that's possible. There are going to be some kind of lawsuits against the rating agencies, because if a company, their fundamentals, even if the Fed's buying their bonds that allow them just to, keep their operations going, you're just delaying a stay of execution is all that is. Remember, they're not just turn around and increasing the profits of these companies like Ford. Ford's going to see a tremendous drop off in auto sales unless some miracle happens and then we turn around in the economy anytime soon. We're looking probably a multi-year slump. Auto sales have peaked. I've covered those charts in the past. They peaked at levels where they've always peaked at in past economic expansion, or the past few, I should say, to be more accurate. And so we're going to go down here. And so again, you can buy all Ford's bonds you want. It's not going to add to their, it's not going to make them profitable. And that's just one example of many I'm trying to use here. By the way, here's a watch list I'm working off. These are the active trades. Let's talk commodities real quick. Corn, not much to say. It's still setting up. And again, corn's not a get-rich-quick thing. It's not like the latest .com or Bitcoin or anything else. But again, I think it's looking nice, and the chart's setting up. And I've covered this one in the past. I just want to mention its entry point was 1268. We're 1267. So we're flat on that one right now. Not much else to say because nothing's changed there. Next up, we have sugar. Sugar, we're at 33.08. We entered at 32.92, so we're up slightly, call it flat on that. Same thing, nothing's changed, but therefore nothing's changed, and the same basis for taking the trade I still like right there. That's sugar. I might have skipped, yes I did, I missed semis. This one I tried to explain today, and I think hopefully that was clear in the post on the homepage. SSG, because I know a lot of people don't have the ability to short. They want to maybe hedge up in an IRA or a non-margin account. And so instead of shorting a one-time semiconductor ETF, I was trying to stay away from the 3-time leverage right now due to the risks in the financial markets. So I went with this one. I usually don't use SSG. I usually, if I'm going to short and you're going to use a leverage ETF, it's this one, which is much more liquid. What do I mean by that? Well, I just flipped over to a 1-minute chart. And you see how this chart looks normal? You see how these candles just look like any chart, whether it's a daily or they're all consecutive. There's no gaps between them. That's a liquid ETF that's trading more shares, more volume. And then when we do the SSG, which like I said, there's more risk in these 3-time leverage right now. 2-time leverage still has risk, but less. But when you see these choppy candles, I just flipped over to change symbols. It's the same time period, and you see these choppy marks here. That shows you they're very liquid. It doesn't trade as often, not as many shares. So you gap down. So as I said in that post earlier, heading into the close, which was right here on Friday, wrong one, right here. Zoom in. There you go, right there. This was it. Heading into the close, we were up here. We were well above the stop. We were trading at 1180 in the very last 2 minutes before the close. After I turned away, figuring, okay, we're going to safely close because it traded there for about 15 minutes. It gapped down intra-period right before the close to close there at 1166. 3 cents, literally 3 cents below the stop. So as I said, that's a trade. You guys probably kept it on. I don't know. You'd have to pull the trigger quick, but I'm a stickler for the details. Since I didn't get anything out, I was going to fire off a post saying all trades look good into the close. I said, no, why not? That one's comfortably above, and I didn't do it, and then I didn't realize till somebody brought it up. And I saw their question this morning about it being stopped out. So I'll stick to that, and just we turned around, and whether you're still in it or not, 6 to 1, half dozen to the other, really. It still looks good. There was our original entry price here at 13.20, so I consider that stopped out. We re-entered today at 11.65, right about where we are at 11.50. And remember, it's 2-time leverage, so it's really, at best you want to take a half position size, maybe even lower. So we'll stick with that for now, and I'll decide whether we're going to modify the stop again, because the market, like I said, it's kind of chopping around sideways now, and this thing may grind around here, so it may make sense to move the stop down a little bit. I'll make that decision before the close, and again, you guys do what you're comfortable with as far as holding it, not holding it. SOXX is the one-time semiconductor ETF, non-leveraged, and you can see just a confluence of moving averages, resistance levels there, everything else. And the case has already been made for this is a longer-term swing short, especially here on the weekly chart. So I just wanted to reiterate that I still like the trade, but trying to swing trade in this environment requires some flexibility. You have to be adaptive, and you have to give some of these trades some room. Otherwise, it's just these day-to-day grinds are going to pull you out, especially when trading the leveraged ETFs. And finally, we have two precious metals as active trades. PALL, which is palladium, that's actually a short, and then we're long gold. So, and because they have different, they both have industrial applications, but palladium more so. That's the big run-up, was a shortage of palladium. It's used in emissions controls, and therefore, if I'm right, and I struggle to see it any other way, auto sales are going to significantly plummet. They have to right now. How many dealerships are full over the weekend, people car shopping and all that in the last month or so, and even then it's a trickle-down effect. You have the highest surge in unemployment claims in history. We've already lost, I think I read, 1/3 of the jobs created over the last decade in the last expansion have been lost in a blink of an eye. I can't even get my head around it. Demand for palladium, I would have to imagine, is going to collapse soon. Either way, the trade's still fine for now. I think our stop is up here at 226.72, and we shorted it on a break below 207. We're right around there now at 208. Not much more to say on that. I still like the trade, that's all. And then gold, finally, I did a pretty extensive update, and this is the one I wanted to talk about, how a couple things that I mentioned that post this morning about the possibility these divergences could be negated. So if gold was in a bearish trend overall, and I saw these negative divergences on a 60-minute chart, I might even short it in advance, expecting a breakout. So what happened on GC gold futures, if you recall, in recent videos, I've highlighted this big level here, multiple reactions and failures around that 1728 level on gold futures. Then we broke above, and we successfully back tested it so far, and we're moving higher. So that's bullish right there. And again, we all see what we want to see. So if you're looking through bear goggles, what a bear sees right now in gold is and I have to acknowledge it because it may play out. Let me just tell you that. And that's why I point these levels out. I can't guarantee where this is going to go. This is a beautiful textbook bearish rising wedge confirmed with negative divergences, and so if it plays out and gold reverses, now it could come down here, hit the bottom of the wedge, bounce, but the big level would be, and the fact they come in together would be the 1728 level plus the uptrend line. A break below that would clearly be a bearish technical event. There are no guarantees, but it would sharply increase the odds if you had a solid break and close that we're coming back down here to at least the 1673 support level. Okay, so that's the bear scenario. Now, the bullish scenario is that gold's in a bull market, number one, and therefore, just like the stock market, can't tell you how many bearish rising wedges in the stock market I pointed out over the last year that either didn't play out or broke down and then had a little whipsaw and just kept going. And the divergences that were in place maybe just never materialized for a correction. They just got burned through. What do I mean by burned through? Well, if the indicators go higher and take out these previous highs here, they move up, then you no longer have the negative divergence. So that is what I was trying to say. So when I laid that out, I think I was very clear on it. This is a potential bearish setup right here, but like anything, support is support until unless broken. So you don't have a sell signal until unless that breaks. And right now we're building on Friday's gains, not by a whole lot, but by 0.82%, which says that's pretty bullish. Then we broke out, we back tested, and we're building on the gains. And so that's that. So our gold trade looks good now. It's been looking good all along. Here's GLD on the daily chart. I think we have the targets over here. Yep. So you can see we put the recent highs behind us and a pretty impulsive move. Remember, you're seeing gold GLD ETFs up over 2%. Gold futures, the thing about those guys, you have to realize what you're looking at, the smaller gain, the 0.8%, is that's today's gain. They traded Sunday night, then that session closed, and then today's session opened. So the reason GLD is up more, add in last night's gains in the futures as well, or really from where gold closed down on Friday, and that's what you got there. And that opens the door up to our next target. So gold's looking good, and then that's it, I believe. Let me make sure I got them all here. Let's just do what we've been doing lately, talk about diversification. So Berkshire is a short trade, and it's down 3%, so we're up on that. That's I'm trying to use a check mark tool here if I can. So there's a check mark. Corn, we're down 0.39%. Costco, the trade's down, so we're profitable. There's another check mark. Gold, we're up. That's a long profitable. LQD, we are down, and like I said, we may have averted a big loss. Maybe we recoup some or all of our losses, maybe even then some. So at least for today, that's up. So there's the fourth check mark. Palladium is a short. We're down for sure on that one today. It's up 4%. Spinning our wheels so far. Sugar, we're down. SPY is a short, so we're profitable on that today. And SGG semis, that one's down. Remember, that's short semis, so we're long on that particular ETF. And then Verizon is a short trade, so not bad. 1, 2, 3, 4, 5, 6 check marks versus 1, 2, 3, 4 X's. So we're up. The majority of our positions are profitable today. And again, we can do this day by day. One day we might have more down, but that just shows you it's kind of spreading your bets there. And so far so good. And I think if we can get a nice leg down over the next week or two, like I think we get in the stock market, we can really see some of those short trades take off and quite possibly, I think, start to snowball to the downside and really get kind of get away from this mostly sideways trading that we've been in for the last week or so here, a couple weeks in SPY, and start to see something where we get those 3, 4, maybe even 5% down days coming here again soon. And get on down here to these targets, and then I'll make the decision whether or not to extend anything past that third and current final target on SPY. All right, that's it. 10 trades updated, and we'll pick this up at the close. If anything big happens today, there's one errand I need to either run out for today or tomorrow. So if anything big happens before the close, I'll try to get that out to you guys. If I'm around, I'm either going to step out today or sometime tomorrow to take care of that errand. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.